Welcome back to Investing Talk Podcast. Today we are focusing our attention on a company really at the intersection of defense technology and commercial space infrastructure, Voyager Technologies. The core question we are tackling, based on the stack of sources we have here, it's simple but critical. Is Voyager Technologies a good time to buy right now? We're going to analyze the fundamentals, look at the recent major operational shifts, and importantly, those high-stakes risk factors to help you form your own view. And hey, if you find value in this analysis, please do remember to subscribe, like the video, maybe leave a comment below. Also, if there's a specific company you want us to review next, just drop that name in the comments.
Yeah, we've got a rich set of sources, and frankly, they're a bit contradictory. You see significant bullish consensus, lots of positive signals, but then those are definitely shadowed by clear warning signs, especially when you look at recent earnings performance and, the cash burn. So our mission really is to assess if the company's ambitious, very long-term strategy can credibly outweigh its immediate and pretty massive profitability challenges.
Okay, let's unpack Voyager Technologies first.
Yeah.
For maybe those less familiar with this defense space vertical, what exactly are they selling? And why are analysts paying, $2 billion for a company with relatively small revenues currently?
Right. Voyager Technologies has carved out a really fascinating position. They're not just, a standard defense contractor or only a space exploration company. They're actually trying to vertically integrate data processing and communications into space infrastructure itself. It operates across three major segments, and they all kind of feed into one another. First, you've got defense and national security. The focus is on high-end, quite bespoke systems. Think next-generation missile defense, advanced hypersonic technologies, that sort of thing. This segment provides, let's say, the stable government contract revenue base.
Okay, stable base there. And the second area?
The second area is, I think, where the moat truly lies. Space solutions. This is really the technological engine. It deals with advanced offerings like multi-cloud processing and, crucially, proprietary optical links. So this isn't just about launching things into space. It's about what happens to the data once it's actually up there, in orbit.
Wait, let's drill down on that for a second. You call this the moat. Why is in-orbit processing so critical? Important enough to justify this kind of valuation?
Well, because it effectively bypasses the huge bottleneck of terrestrial communication. Sending massive amounts of data back down takes time and bandwidth. Proprietary in-orbit processing lets clients, governments, commercial entities process raw signal intelligence, sensor data, whatever it is, autonomously. Right there, in space, often using machine learning. This dramatically cuts down data latency, slashes bandwidth costs back to Earth, and offers, immediate tactical decision advantage. This technological lead is precisely why their long-term contracts are seen as so defensible.
Got it. So that technical differentiation is absolutely key. And then there's the third segment, the one that seems to be generating the most hype, the Starlab Space Station's joint venture.
Exactly. Starlab positions them right at the forefront of commercial space infrastructure. They're essentially building or helping to build the next generation private orbiting platform. And this is a huge multi-decade project. So when you combine these pieces, high-end defense systems, proprietary data processing tech, and a major stake in future space infrastructure, you start to see why analysts are buying into the growth story, despite the current numbers.
Okay, moving from the technology to the money side then. Here we see that, the famous contradiction you mentioned. Rapid top-line growth, sure, but battling really significant losses. Can you walk us through those numbers? And maybe more importantly, what do they imply about the kind of growth trajectory that's required here?
Yeah, the financials, they absolutely reflect a classic high-risk, high-reward growth stock scenario. It's textbook. Looking at the last 12 months, the TTM, the top line, hit about $157.49 million. Which is, respectable growth. However, for that same period, net income was a staggering loss of an initial $104.83 million.
Wow. Okay, let me push back on that immediately. If they're losing over $100 million on roughly $150 million in revenue, that means for every dollar they bring in, they're losing something like 66 cents.
Yeah.
And the company's valued at $2.02 billion right now. That valuation seems completely untethered from current financials. What are investors actually betting on here?
That is the crux of the analysis, absolutely. Investors are essentially betting that management can scale revenue by a factor of, say, 8x to 10x over the next 5 years or so. They need to transition from being primarily an R&D burner to becoming an operational powerhouse. This huge negative net income, that's the cost of building that moat we talked about. It's funding the aggressive R&D, the capital expenditures required for Starlab. The market seems to be accepting this massive cash burn because the addressable markets, defense modernization, commercial space, these are multi-trillion-dollar sectors eventually. And while specific debt-to-cash ratios are a bit difficult to pin down from the latest SEC filings, the company's consistent ability to pursue strategic acquisitions does suggest they have sufficient liquidity, or at least access to capital to continue funding this growth for the near future anyway.
So the market is giving management a huge runway, basically assuming successful execution down the line. What milestones are analysts looking toward that might start to bridge that profitability gap?
Well, the immediate focal point is definitely the upcoming Q3 earnings. That's scheduled for November 21st, 2025. Analysts are expecting strong year-over-year revenue growth, and this projected optimism, it's tied directly to the scaling of those operational units we mentioned, specifically Starlab and Space Solutions. The hope is they're starting to convert those heavy R&D investments into initial tangible revenue streams.
Right, which leads us perfectly into the catalysts. If they're burning this much cash, they must be doing something big, or claiming to. Let's pivot now to that flurry of recent corporate activity. The moves management is presumably using to justify that loss.
Yeah, the strategic activity in late 2025 has been pretty much nonstop. It does demonstrate an aggressive commitment to execution. You have to give them that. We really need to look at the strategic moves made just in September and October. Okay, first, they acquired Bridgecom. This is critical. Bridgecom is a specialist in optical communications, think laser speed internet, but for satellites. This acquisition wasn't just about padding revenue figures, it was about vertically integrating a key piece of technology that's necessary for their new Space Edge platform, which enables that high-speed, in-orbit processing we were just discussing.
Okay, so the acquisitions are highly targeted then. They immediately bolster that competitive moat you described. What about the Starlab project itself? Any movement there?
Yes, progress on Starlab has actually been pretty strong recently. They secured a new manufacturing partnership with VOYG. And critically, they added a new European joint venture partner. This strategic partnership expansion, it's crucial for validating the global market potential of a commercial space station. Basically, they're trying to show there's real global demand for the infrastructure they're building. They also recently bolstered their internal structure, key leadership hires, like a new chief technology officer. These are, operational actions designed to ensure they can actually deliver on the massive technical promises they're making to the market.
And speaking of delivery, analysts are certainly banking on it, aren't they? Tell us about that consensus rating and the potential price upside everyone's looking at.
The consensus is undeniably bullish, yes. 7 analysts currently covering Voyager technologies have a collective buy consensus rating. That's pretty strong. The average 12-month price target stands at $47.71. Now, considering the stock was trading somewhere in the low $40 back in July, this represents somewhere between a 39% to 46% potential upside, and that substantial discount to consensus targets is a huge reason institutional investors are interested right now, I think. They believe the market hasn't fully appreciated the value of these recent strategic execution moves just yet.
Okay, but we have to give you a balanced view here, so let's shift gears and talk about the risks. Volatility is clearly a factor, especially around that major disappointment in the Q2 report. This really seems to be the primary point of skepticism for any cautious investor looking at Voyager.
Absolutely. The most significant concern, the thing that caused major price volatility, was definitely the Q2 2025 earnings released back in August. The company reported earnings per share, EPS, of the ever 10 60 cents. That was a massive miss against analyst expectations, which were around $1.27.
Right, a miss of that magnitude. I mean, that's almost catastrophic, even for a high-growth, high-burn company like this. If revenue actually beat estimates, which you said it did, with 24.5% year-over-year growth, what exactly caused that huge $33 per share hole? Was this some kind of one-time accounting write-down, or is it maybe a sign of systemic cost overruns in their defense contracts or these new platforms?
That is the fundamental question, isn't it? And it's driving the divergence we see in analyst ratings. The massive miss suggests either potentially highly aggressive upfront R&D expensing, or perhaps early-stage cost overruns on those new platforms like Space Edge or Starlab. It's hard to tell from the outside. This mixed result revenue beat, but EPS collapse led directly to target downgrades from some analysts. Bank of America, for instance, lowered its price target from $50 down to $41. And less forgiving was Weiss Ratings. They reaffirmed a clear sell D rating just in October. So this disparity really shows the street is split. You have those who see the loss as necessary investment for future gains, and those who see it as dangerously high operational inefficiency right now.
And what does the stock's actual price history tell us about this risk profile? How's it been trading?
Well, the 52-week trading range is pretty telling. The stock has seen some really high swings, moving between $26.10 on the low end and $73.95 on the high end. That kind of wide range tells you this is definitely not a safe haven investment. Far from it. However, the recent gains shares were up over 18% during one 2-week period in October, suggests that, at least for now, the market is favoring the execution narrative over the recent earnings disappointment. But the core risks, they absolutely remain: the difficulty of managing such a high cash burn rate, potential execution delays on incredibly complex space programs like Starlab, and of course the inherent exposure of the whole sector to unpredictable government contract timing and, frankly, geopolitical cycles.
And we also have those, let's say, lingering, unverified rumors swirling around, right? Potential new government contract awards, maybe a huge win from NASA or the Department of Defense, or perhaps a major new Starlab partner announcement. These speculative catalysts certainly add some short-term juice, you could say, but they also amplify the risk considerably.
Definitely. Any materialization of those rumors would likely trigger a huge spike in the stock price, no doubt. But for long-term investors, the focus really has to remain on the verified strategy, the actual execution. They've laid out the pieces, now it's all about connecting them effectively.
So wrapping this up, what does this all mean for you, the investor, perhaps looking to buy in now? We have this incredible growth potential, it seems, rooted in very strong long-term secular trends, defense modernization, commercial space, but that's battling against recent earnings disappointment and that really high cash burn.
Yeah, the sources strongly suggest Voyager Technologies is at a critical inflection point. It really feels like it. The overall bullish rating we see from analysts is high. Yes, primarily because it dominates or aims to dominate those secular growth markets. And importantly, it's currently trading at that substantial discount to the consensus price targets. So this stock could be seen as suitable for either short-term trading, maybe trying to leverage the Q3 earnings catalyst or potential contract announcements, or for long-term investment, looking to capture the multi-year Starlab growth trajectory. But the decisive factor for success, honestly, regardless of your time horizon, is going to be management's execution capability over the next 6 months to a year. Can they deliver?
Okay, a final thought then for you to explore as we close out. We know the Q3 earnings on November 21st are a major near-term event, focusing mostly on revenue and loss figures. But looking slightly further out, maybe the Starlab Critical Design Review CDR milestone, expected in early January 2026, is actually the single biggest determinant of long-term value. So how will the successful completion of that CDR, which basically confirms the detailed design, the engineering, the manufacturability of the space station itself, moving way beyond just financial reporting, how will that fundamentally change the market perception of this commercial space infrastructure company? Something to think about. Thank you for joining us for this analysis.